Welcome to Modiri Trade podcast series. You're listening to podcast with title 10 Things That Brokers Don't Want You to Know. As a potential investor, it's important to be informed about the investment process and the role of brokers in facilitating that process. Brokers act as intermediaries between investors and financial markets, helping investors buy and sell securities, such as stocks, bonds, and mutual funds. While many brokers are reputable and have their clients' best interests in mind, there are some things that brokers may not want you to know. Here are 10 things to keep in mind when working with a broker. 1. Brokers make money from commissions. Brokers make money by charging commissions on the trades they execute on behalf of their clients. This means that the more trades a broker executes for you, the more money they make. While this can incentivize brokers to be more active with your account, it's important to remember that excessive trading can also lead to higher costs and lower returns. 2. Not all brokers are fiduciaries. A fiduciary is someone who is legally obligated to act in their client's best interests. While some brokers are fiduciaries, not all of them are. Brokers who are not fiduciaries may have conflicts of interest, as they may prioritize their own interests or those of their firm over their clients' interests. 3. Brokers may push products with higher fees. Brokers may receive higher commissions for selling certain investment products, such as mutual funds with higher expense ratios. This means that brokers may have an incentive to push these products, even if they're not the best option for their clients. 4. Brokers may not disclose all fees. In addition to commissions, brokers may also charge other fees, such as account maintenance fees or fees for transferring your account to another firm. It's important to ask your broker about all the fees associated with your account, so you can understand the total cost of investing. 5. Brokers may not always have access to the best prices. Brokers may execute trades on behalf of their clients through a variety of channels, including electronic trading platforms and human traders. Depending on the channel used, brokers may not always be able to access the best prices for securities. 6. Brokers may not always have your risk tolerance in mind. Brokers may have different risk tolerances than their clients and may be more willing to take on riskier investments than their clients are comfortable with. It's important to communicate your risk tolerance to your broker and ensure that any investment recommendations are aligned with your goals and risk tolerance. 7. Brokers may not always provide the best investment advice. While brokers can provide investment advice, they may not always have the expertise or resources to provide the best advice. For more complex investments, such as derivatives or alternative investments, it may be best to consult with a specialized advisor. 8. Brokers may not always disclose their conflicts of interest. Brokers may have conflicts of interest, such as receiving incentives or compensation for recommending certain investment products. While brokers are required to disclose these conflicts of interest, they may not always do so proactively. 9. Brokers may not always be transparent about their performance. Brokers may report their performance in ways that are not transparent or comparable to other brokers. It's important to ask your broker about their performance metrics and how they compare to industry benchmarks. 10. Brokers may not always be necessary. While brokers can be helpful in facilitating investment transactions, they may not always be necessary. Many investment platforms now allow individuals to invest directly in securities, bypassing the need for a broker. It's important to evaluate whether using a broker is the best option for your investment needs. Conclusion: while brokers can be helpful in facilitating investment transactions, it's important to be aware of their potential biases and conflicts of interest. By staying informed and asking the right questions, investors can ensure that they're making informed decisions and are working with brokers who have their best interests in mind. Additionally, investors can consider alternative investment options that may not require the services of a broker. Ultimately, the key is to prioritize transparency, communication, and education when working with a broker or making investment decisions. If this is your first time listening to our podcast, please don't forget to subscribe to our channel Modiri Trade and turn on notifications to be the first to listen to the next podcast. Have a great day.